Okay guys, today we're going to talk about accounting for a merchandising business, and we're going to see that it's a little more complicated than accounting for a service business. So in a service business, everything was pretty clean cut. We had fees earned, which was the revenue that we received, or I'm sorry, I should say the revenue that was earned. Remember, under the accrual basis of accounting, we record revenue when it's earned, regardless of when the cash is actually exchanged. So we started with our fees earned. From that, we subtracted out our operating expenses, and those are the expenses that are part of operations, of course. And once again, under the accrual-based system, we record expenses when they're recorded, regardless of when we actually pay for them. The difference between all of the fees that we earned and all of our expenses is our net income. That's how profitable we were for that period of time. And if our expenses were more than our revenues, then we would have a net loss. Merchandisers have something called inventory. And inventory are those items that they purchase to resell. Inventory is an asset until it is sold, and at that point it becomes cost of merchandise sold. So this is the typical format for the income statement of a merchandising business. We have our sales from selling inventory or selling products. We have the cost of the merchandise sold, and that gives us a little subtotal here called gross profit. And from gross profit, we're going to subtract our operating expenses like utilities, wages, property taxes, and things like that. Okay, so this is a little bit redundant right here. And so take note, once again, merchandise on hand that is not sold at the end of an accounting period is called merchandising inventory. Many times our accounting period is going to be a year. Sometimes, just for management purposes, a company might want to see financial statements prepared on a monthly basis. Let's speak quickly here about the perpetual versus a periodic system of maintaining inventory. So the main difference is, with a perpetual system, we make an additional journal entry with each time we sell an item of inventory. So at any point in time, we should know how much inventory we have on account. We keep track of how much we've purchased, and with every single transaction, like when you go to the grocery store, when they ring things up at the register, not only are they determining how much you owe them, but they're also keeping track of how the inventory is flowing out of the store, so if they start to get low on some inventory, they can replenish it. It's a bad thing for a company to lose money because there's no inventory and people want to purchase that inventory. So the perpetual system is used nowadays with many companies, and with technology being the way it is, it makes it very easy to maintain. Now this is different under the periodic system that we're going to talk about now. And so it says here in the periodic inventory system, sales are recorded as they occur, but we're not going to make that second entry to show the outflow of inventory when sales take place. Instead, we look at the amount of inventory that we had at the beginning of the accounting period. We look at what we have left at the end. The difference between those two is the amount that it's going to be our cost of goods sold. Kind of the same way when we were working through supplies. We looked at the supplies we had on hand. We added to those any supplies that we purchased, and we looked at the end of the accounting period at the amount of supplies that we had left, and in that example, the amount of supplies that were missing we called supplies expense. Now, regardless of what inventory system is used, it's good practice to perform a physical inventory count at least once a year. So under the perpetual system, we do keep track of all amounts of inventory that come in and go out. But believe it or not, sometimes people steal from businesses. So that was a joke. It happens all the time. So we need to perform a physical count to see if there's a difference between what our accounting records show for inventory and what actually is on hand.